Using a credit simulator can provide tailored insights into improving a borrower's credit score. It's incredibly useful. I'm going to give you 5 of the best strategies you can use to use credit simulators. Number 1, I want you to focus on paying down credit card balances. You might be asking yourself why. One of the most influential factors in a credit score is the credit utilization ratio, which is the amount of credit used compared to the total available credit. Keeping utilization below 30% or even better under 10% can significantly improve the borrower's credit score. How to use the simulator. You're going to input different scenarios where the borrower pays down specific credit card balances to see if it affects the score. You're going to focus on reducing balances on cards with the highest utilization rates. That's going to boost their credit score the most. Normally, at least that's an easy and fast way to fix their credit, okay? The second thing I suggest is correcting credit report errors. Now, why would you do that? Basically, because there's always going to be some kind of error on the credit report, either on the account balance, either on the payment history, or general account information, which can lead to a drop in your borrower's credit score. Now, how would you use the credit simulator to do this? First of all, you're going to identify different situations by simulating the removal of those errors and seeing if it requires any other changes, and then double checking to see if that increases the borrower's credit score or not. A lot of times you're going to make changes and it won't have a significant effect on the borrower's credit score. So then you move on to trying to find a different option or solution. Number 3, paying off collection accounts. Why would borrowers pay outstanding collection accounts? Well, because by paying down or bringing down those accounts or paying them off, it can lead to a significant credit score increase that will boost them and allow them to qualify where they wouldn't normally be able to qualify. When you have collection accounts, those are the ones that drop scores the most, which can also create a bounce back effect by paying those off. Number 4, increasing credit limits. Why would you ever want to increase the borrower's credit limit where they can spend more on credit cards? Well, by increasing the credit limit on existing credit cards, a borrower can lower their credit utilization ratio by paying down their balance. This can lead to a positive impact on their credit score. And if they're short on money and they can't pay down any debt, if they increase the limit that they have on their credit card, for example, if they have a credit card with a $1,000 limit and they owe $500, or they owe all $1,000, and they increase the limit to $5,000, now that $1,000 represents only 20% of what they're utilizing on their credit available. Number 5, become an authorized user on a credit-worthy account. Now, why would you ever do this, or why would a borrower ever do this? Well, being added to an authorized user on a credit card account that's been paid on time and has a positive credit history can really boost the borrower's credit scores. Any history that comes from the main cardholder's account will come onto the borrower's credit profile as well. So if they've paid on time for 3 years, it'll latch on to the borrower's credit report, making them appear to have a much more credit-worthy credit report and history. Now, if you're asking yourself, how would you use a simulator or the credit simulator to do this? You're going to input the scenario where the borrower is added as an authorized signer to an account with good standing. The simulator is going to show you how this addition can potentially impact the borrower's credit score, allowing them to see the benefits before making this move. So it really saves you time and money. By using a credit simulator, mortgage professionals can test these strategies and create a customized plan to help borrowers maximize their credit scores effectively before applying for a mortgage.